For the last several weeks, I've been saying that higher Treasury yields have been creating headwinds for the U.S. equity market. Well, those headwinds have dissipated. Since last week, the yield on the 10-year Treasury has dropped from 4.78% down to about 4.55%. That's a fairly significant decline, and in response, U.S. stocks are going up. Since over the last week, the S&P 500 is up 3.2%, and it's now only about 0.2% away from an all-time high. Boosting the market, besides those lower Treasury yields, and I want to be clear that that's the main thing I think that's helping the market, but also out there has been a relatively positive response from the first 2 days of the Trump presidency. The market was generally happy that Trump wasn't moving immediately to put tariffs on other countries. And then secondly, and probably more important than Trump, is that that fourth quarter earnings that have gotten reported have been very good. So far, companies are beating analyst estimates by 10% on average. That's quite a bit better than they normally companies beat analyst estimates, but 10% is a pretty comfortable margin. The first companies to report have been the banks, or at least I say they've been dominating the first companies to report, and those earnings have been very, very good. And you can see the banks have responded by moving higher. The KBE, which is the bank ETF, is up about 6.6%. Over the last week. I think the bank industry has already pretty much priced in that business for the banks were pretty good in the fourth quarter and also look like they're going to be pretty good for the year, for 2025 going forward in general. And you can kind of see that with a reporting that happened last night after the close. Capital One, which is a bank a lot of people in Asia are not really familiar with the name, but it's a sizable bank and it's the third largest issuer of credit cards in the United States. Capital One released its earnings after the close. The earnings were very good. It said very good things about what business is going to be like in 2025, yet the share price dropped. So the market has already kind of said, okay, we're priced in a lot of goodness with the banks. But that doesn't mean that it's necessarily going to assume that you're going to have very, very good results for the other sectors. However, even if those other sectors don't do quite as well or beat analyst expectations by as much as the banks did, it's still got to be largely a boost for the market because right now, overall, when everybody's reported, according to FactSet, U.S. year-on-year earnings growth for the fourth quarter is going to be 12.7%. That's a pretty strong earnings growth. That's very friendly to the market. And since we're already in a mode where companies appear to be beating analyst estimates, it would seem pretty likely that we're going to have 13% or even higher earnings growth quarter on quarter in the fourth quarter. So that's got to keep the market humming. So I will be, well, how should I say this? I won't be surprised at all if when I'm talking to you next week, the market is at an all-time high. The other good thing that we can say about what's going to happen with earnings in the fourth quarter earnings and earnings for 2025 is last year, most of the earnings growth were coming from really big tech stocks. And those big tech stocks, the Mag 7, are still going to be growing their earnings more quickly than the market generally. But the other 493 stocks, the S&P 493, if you will, the ones that aren't in the Mag 7, they're probably also got to have 10% earnings growth this year. So that's a welcome improvement from last year. And you can kind of see, the importance of the Mag 7 going into this year may not be as great as it was last year because you had Apple, which is obviously a very big heavyweight stock in the US. You had Apple down, I think it was down about 4% yesterday, yet the overall market went up. Apple shares declined because people are getting more pessimistic about iPhone sales, and the company is trading like a growth company. It has a fairly high valuation. So if iPhone sales aren't doing so well, people will have to revisit their thoughts about what the multiple for Apple should be. I started off this presentation by saying that the market was mostly, in my view, being boosted by declining Treasury yields. Do I think they're going to decline further? Well, my little calculation, and I'm not an economist or a super expert on this subject, but the way I looked at it, I thought the right yield for the 10-year was around 4.5%. So the 10-year yield declining from 4.78 going down towards 4.5% didn't really take me by surprise at all. But also, if you say, well, do I expect further declines? Well, I'll say no. I mean, it could decline further. Markets can do what they want. But, basically, I think 4.5 is the right number. Built into my thinking about why 4.5% is the correct rate is that U.S. GDP growth is going to slow down as the year goes on. The fourth quarter of last year, the U.S. GDP grew at 3%, according to the Atlanta Fed tracker. When we get the first official estimate of GDP from the Commerce Department, it may be a little bit lower, but that's a very strong growth for the U.S. So when I say it's going to slow down, I'm just saying, well, it's going to go slower than the very fast pace of growth that it's going on now. And the other thing I'm assuming is that the inflation rate in the US is going to drop during the year. However, let's say I'm wrong on that and the US economy continues to hum at a near 3% rate. And inflation, maybe it doesn't go up, but it only declines at a glacial pace, which is what it's been doing for the last 3 months. So that's not out of the realm of possibilities. You could have that 10-year yield go right back up towards 5% if that was the scenario. And once again, that should create headwinds for the equity market. So I'm not predicting that. I'm not saying that's what's going to happen, but just remember that 10-year is very important to the market. Even though it's very fun to talk about Trump, I think the 10-year yield is a lot more important going forward. Things look bullish now. We're going to be getting very strong earnings from U.S. companies. My expectation is that the market continues to move higher, but maybe as earnings season starts completing, we'll see the market kind of run out of gas. And then the future of the market would have a lot to do with whether we see Treasury yields drop a little bit further or whether they go back up again.